Every trend leaves a clue in the market. If you can interpret those clues clearly, the market becomes a lot clearer for you to read. In today's lesson, we're breaking down one of the key fundamentals of technical analysis, which is the law of the bullish market. By the end of this video, you will know how to identify a good uptrend market and, more importantly, when that trend is in danger. So let's go back to the chart.
What is a bullish market? A bullish market is a market that is trading to the upside. It's a market that the price it is going up. I repeat, a bullish market is a market that is trading to the upside. Now, there are some factors we need to look at when identifying a bullish trend, and those factors are: one, the higher high. The higher high. The higher high is found at the resistance zone. The higher high is found at the resistance zone. The second factor is the higher low, which is found at the support HL. The higher low, it is found at the support level. The higher high is located at the resistance zone. That is where the higher high is located at the resistance zone. Excuse me. While the higher low is located at the support zone. The higher low is located at the support zone. That's where the higher low is. So let me just quickly copy that. Let me copy it and put it on the other side so that you can see it clearly. Okay, copy. Yes, correct. So the higher low is located at the support zone, while the higher high is located at the resistance zone. So let me copy that also. Copy. We clone. Not copy. It's clone. Any I want to put it. So this is how the bullish market structure looks like.
Laws of the bullish market. The first law states that the market must continue to break the higher highs, meaning the market will keep on breaking the resistance zone, because resistance zone is the ceiling in price, which is pushing price down. And for the bullish structure to continue, it must always break past that resistance zone. The second law says that the market must protect the higher lows. The higher lows must not be tampered with. The market cannot break past the higher lows because that is the support zone. Support is pushing price up, and we are in a bullish market, so the market tends to go up. Then when the market is going up, you have to keep on taking the higher highs and maintain the higher low. The third law says that the trend remains bullish until a higher low is broken. So until a higher low is broken, that trend is still bullish. The market must not break the higher low. Anytime the market tampers with the higher low, that trend is over, or there want to be manipulation that want to take place in the market, or something want to happen. So that trend is, that my bullish trend is kind of, it's not stable again. But for that trend to be stable, the higher low must be maintained. The higher low must be maintained because that is the support zone, which tends to push price up. So the market must not break the support zone, but it must always break the resistance zone. Markets must not break the support zone, but it must always break the resistance zone.
Now that we have gotten the law of the bullish market structure, which states that the higher high, the price must keep on breaking the higher highs, which is the resistance. Price must keep on breaking the resistance, but must never break the support zone, which is the higher low. Now, this is what a real market bullish structure looks like. The previous one was just to show you what the law stands for, how the law is. And this is where most traders get it wrong. They don't know where to place the right higher highs and higher lows. This is where they are getting it wrong. So let me show you how it is. We're going to like this. Then I know your mind will immediately I know your mind will immediately tell you that this place this particular low now, which is that support zone. This support zone now is the higher low. Let's keep on looking at the chart. Price will just come down, then break it. And you might be like, why? Why the markets break that particular zone? Why the price break that particular zone? I will explain to you guys why. So let's continue. Then it goes up, break this place, and comes down. Stretch it like this. Start going up again. Then come again, break again. Then flies up. Let's put it like this now. Excuse me. So now you guys will ask, like, why did the market break this place? Because the law said that the market was not break the support zone, right? So yes, it's support zone, but why the market go below that support zone? Now that place is a support zone, but that is not the higher low. Why? Because market has the first market has a characteristics of inducing traders, of tricking traders, of tricking them. You want to make them to enter early. So this zone now here, you make traders enter early. That's what we call an inducement zone. An inducement is a place in price that tends to trick traders to enter the market early. So inducement, we just IDM inducement. IDM stands for inducement. So the market creates this false low, then it trades up. You now think market is leaving you, you will now rush enter the trade. The market will now reverse down and break that inducement zone and break past that place. And most traders will be like, since the market has broken that support zone, so let us start selling the market now. The market has changed character, has changed trend. They will not start selling. That's where they are trapped. So the market has kicked out the early buyers. Now sellers have entered the market. Now the market will now also kick out the sellers. Now most sellers will put their stop losses here in this particular zone, which is the higher high here. Some don't use stop loss. Some don't use stop loss. All these mental ones. Those that use mental stop loss, they are mental. Then the market will now start going up as usual. Then take out this place. So this place is the higher high. Why is that the higher high? Because that is the highest of both highs here. This high and this one. This is the highest one here. So let's annotate that. Higher high. Higher high. Then after market break past this place, the art of breaking past the previous higher high is what we call the break of structure. When the market trades above the previous higher high, that's what we call the break of structure. Break of structure. BOS. Break of structure. Then the market might start retracing down. Normally after an expansion, there's always a retracement. Then when I create this false low again, this is what the market does. It like to create false lows and false highs. Now this is the higher low here. This is higher low here. This is the last higher low that created. Now for you to know the higher low, the market will first take out inducement. For you to know the right higher low, market will first take out inducement zone, then head straight to the higher high. This is the last low that was responsible for taking out this previous higher high. I repeat, before you identify the higher low, market must first take out an inducement zone first, a low, a previous support zone. Then the last low it created will now be the low responsible for taking out this previous higher high. As you can see, this is the last low before the market took out this higher high. So automatically this place is the higher low. So market should not break past this place according to the law. The law states that the market must not break past the higher low for that bullish trend to remain bullish. So in all the market's foolishness, the market if the market is still bullish, it will not tamper with the higher low. Then it trades above the higher high, then comes down, start retracing, it creates this false low. It creates this false low. Then ask yourself, which low did the market take out before moving this before going up? No low. So automatically that place is an inducement zone. So the market must take out early traders. So these people that see this low now, this support form now, and start entering from that place now, the market has tricked them to enter early. The market will now will now come down, take out all their orders, they take out all their stop losses there, which is this place there. So that place is an inducement zone again. You now take out all their orders there, then start trading up and go for this higher high. For that higher high. So immediately market break past this higher high, we have the break of structure. You see here. Then the last low that was responsible for taking out inducement and taking out the higher high is what we call the higher low. Now, if you notice in this structure, the market kept on breaking the higher high, which is the law of the bullish market. It must always break the higher high. But in all its foolishness and the manipulativeness, it never took out the previous higher low. You can see what took out the previous higher low. Now, you might say this is a drawing, it's just a drawing. Okay, now let's head over to the chart. Let's see what the real chart looks like. Now we are in the real chart. Let us see whether what we said before is actually what happens in the market. So let's start. This is the example of a bullish market. So let's use the line and annotate it for us. So we have the low, the market traced up. Then we have that first support zone, market retrace down. Then it trace up again. Then it retrace down and breaks that low, and breaks that particular low there, which that first support zone breaks it. Then immediately trace straight for the higher high, for that high. Then we have an retracement there again. Market retraces down, creates a false low again. The market just like creating that false low to trap traders to enter the market early, to create that false low. Then it break past that false low again, which is that inducement zone, break past the inducement zone. Then head straight for the higher high. Then it retraces again, creates a false low again, which is the work of the market. Then it retraces again. So let's just stop there for now. We have the break of structure there. The break of structure, because when market break past the previous higher high, that's why we have the break of structure. BOS, break of structure. Then we have the second break of structure up there. BOS, BOS. No. We have the inducement zone, which is that first support zone. Then the market trades to that support zone, then trades for the higher high. That support zone, that first support zone that the market trades below, is what we call the inducement zone. And we have the other one right there, the inducement zone. That is also a first support, just like we said earlier on the drawing. Inducement zone. Now we have the higher highs, the higher high. Why is that one the higher high? Because that is the highest of the both highs there. That is the higher high. That was the high that was responsible for taking out the inducement. That is the higher high. We also have the second one. Why did I use the second one? Because it is the one that is highest of the first one. It's not like we said earlier before, the one that is highest of the first one. And that was the high that was responsible for trading below the inducement zone. That is the higher high. So now we have the higher low. The low that was responsible for taking out the inducement zone. The last low. After market took out the last, that's inducement zone. It went straight for the higher high. That's what we call the higher low. That's what we call the higher low. The same thing for this side. It took out the inducement zone. That was the last low that traded through to the higher high. So the law is intact. The law is intact. Just that most traders don't know how to apply the laws correctly. So we also have another higher low there. So that is an inducement zone. That was a low before the market went straight for the higher high. That's an inducement zone there. That was the last higher low there. That was the last low. That was the last low before the market traded us. That is the higher low. Most traders don't know how to identify this correctly. That is why they are failing tremendously in the market. So, because if you notice now, this is a very clean one. Let's look at the chart. Very clean now. If you notice, the market never broke past the higher low. Market never broke past the higher low, but it continuously breaks the higher high. I repeat, the market continuously breaks the higher high, trade above the higher high, but it never trades below the higher low. Market never trade below the higher low, because that's the support zone. The support zone is what is pushing price to the upside. So market never trade past that particular place, but it kept on breaking the higher high. It kept on breaking the higher high. Now let's see what happens when the market violates the higher low. I can see the recent higher low there. Price violated it in that candlestick there. It traded below it, like it broke past it. Now let's see what happened to the market after that. Let me zoom in a little bit. I can see the market started selling. The market started selling. Immediately the market broke the higher low, market started selling. I can see when the market was respecting the higher lows and breaking the higher high, the market was going up. But immediately the market broke past one of the higher low. You can see what happened. Immediately the market broke past the recent higher low. The market started trading to the downside. So remember, the law of the bullish market says that the price must keep on breaking the higher high, but must never tamper or trade below the higher low, which is the support. So the market must keep on breaking the resistance, but must never ever break the support zone. If you found this video helpful, do well to hit that like button, hit that like button. Subscribe, make sure you subscribe. And also share to other traders, your friends who need clarity in trading. My name is SIGMUS. I'm helping you decode the market step by step. So see you guys on the next lesson. Our next lesson will be on the bearish market.